Q3 revenue coming in above estimates, $102.35 billion. The estimate was just shy of $100 billion. CapEx spend also continues to ramp up, nearly $24 billion. The estimate was just over $22 billion. Operating income did miss expectations. YouTube ad revenue coming in slightly better than expected, and overall Google ad revenue also coming in significantly better than expected, $74.18 billion versus the expected $72.46 billion. Now on an EPS earnings basis, beating expectations there, $2.87. The expectation was for $2.26. Now, if that was the case, it would have been the slowest profit growth in over 2 years for Alphabet, partly reflecting that EU antitrust fine. But when it comes to this company, you are just seeing time and time again them outperform when you look at earnings. You're seeing that reaction in shares up about 4% in after hours trading. And it's an interesting company when we talk about AI. It's both a tailwind and it's also a threat here because Google's search business with OpenAI, that just emphasizes some of those competitive pressures. But at the same time, we do see that its Gemini AI models, Google Cloud's AI infrastructure deals with Meta, Anthropic, and even OpenAI have boosted optimism across the board. And when you look at the street targets, a lot of analysts out there are super bullish on this name, having price targets up as much as $300 a share. And we're inching closer to that number now, Josh, nearing 280 or 290 bucks a share as, you know, we continue to see the stock climb in after hours.
Yeah, what's impressive is this stock had a rally into this print. I mean, this was already up about 40% this year heading into the report. You're tacking on almost 6% in the after hours. Yes, it's about advertising and services. It drives the top line, but a lot of focus, as you rightfully pointed out, Ali, on that cloud business, and that did look like a beat. The revenue 15.16, the street was at 14.75. We have seen a number of AI deals involving Google Cloud, so in some sense you had a clue this was coming. Also, like its big cloud rivals, of course, Google is investing a lot in AI data centers. So I was looking at that CapEx number. It looks like they're seeing full year 91 to 93 billion. They had seen about 85 billion.
Yeah, that's a significant rise there. And I mentioned the competitive pressures with search. Search continuing to be resilient here, a beat, 56.57 billion. The estimate was for just under 55 billion. So search doing well, cloud doing well, increasing that CapEx spend, beat on both the top and bottom lines. Shares are up 6%.
The other thing, okay, you point out the search. I mean, that is the big over. With OpenAI, which we talk about constantly, the products, the partnerships, what kind of risk does Sam Altman's app pose for Google long term? We have a smart analyst coming up. Meanwhile, by the way, I'm seeing Microsoft. Those are coming out. Let's get to that. Q1 EPS. I see 372. I do not see a compare yet on that. But Q1 revenue, let's look at the top line, 77.67 billion. That looks like a beat. It looks like the street was closer to 75.55 billion. It looks like Q1 Azure other cloud revenue ex FX, I'm seeing plus 39%. Q1 Intelligent Cloud overall, 30.9 billion. The street was close to 30.18 billion. You would expect to see the guidance, of course, on the call from CFO Amy Hood. That's when you would get the color there. But we do see the stock initially here down about 4%.
Yeah, and I'm curious why maybe earnings coming in below those expectations. Again, we're waiting on that comp. But you mentioned the Intelligent Cloud revenue. That does include the Azure business coming in ahead of expectations. Of course, we did earlier today see a little bit of disruption when it comes to Azure, and it's a reminder of how tethered we are to the internet after that AWS outage not too long ago there. But shares are down roughly 4% at this point. And for a company like Microsoft heading into the print, the setup did look pretty positive. We've been speaking to analysts all week, and they have cited stronger enterprise tone, accelerating AI infrastructure demand from partners like OpenAI. Of course, we have that reset of that partnership with OpenAI. Microsoft holding a 27% stake in OpenAI's new for-profit public benefit corporation that's valued at roughly $135 billion. While OpenAI's nonprofit does retain that control, Microsoft does have the slight edge there in terms of the stake within this company here. So we'll continue to digest these results, parse through what could be driving shares lower, and of course the call is always important when it comes to those headlines.
Yeah, it'll be interesting there. At least initially here, it looks like Q1 Azure and other cloud services, XFX, plus 39%. I see that beating. The street looks like consensus 37.1%. Again, we'll wait for the call for more color from the CFO there.
And that's when they're going to provide forward-looking guidance on the earnings call too. So investors sort of wait and see mode to see what type of guidance could come in on the call. But yeah, I am curious to know what's driving shares, and we'll have to dig into this results in the report a little bit more. Shares down around 4%.
Are you seeing Meta yet, Allie, by any chance?
I am seeing Meta. Let's see. Fourth quarter revenue, they see that between $56 billion to $59 billion for the forecast. The estimate was at $57.38 billion, so it seems like that's mostly coming in line with expectations. It is taking a nearly $16 billion non-cash charge on a tax bill. Let's see if we can find the EPS. $1.05 versus $6.03 year over year. I don't think that's the estimate though. That is the year over year comp here. We are seeing lower year over year Reality Labs revenue in the fourth quarter. That's part of the forecast. Shares taking a nosedive here, down around 7%. So these third quarter results not really doing it for investors at this point. They do see a significant cut in U.S. federal cash tax payments, expects to invest aggressively to meet compute needs. And for a company like Meta, it's a little bit different from Alphabet and Microsoft because they are really using AI to boost engagement. I'm trying to look and see what their ad revenue came in. Ad revenue did beat expectations, $50.08 billion. The expectations were $48.6 billion roughly. So ad revenue at least beating those expectations. Revenue also beating expectations, and operating income up 18% year over year. But I wonder if maybe Reality Labs or some of these other headlines kind of giving investors a little bit of a shake right now because we are seeing losses accelerate.
Down 7%. It had a nice run. It was about 30% this year heading into the print. Guidance for the holiday quarter, I'm just looking at it. That looks to be in line.
Roughly in line,
yeah,
right?
So they're forecasting fourth quarter sales. It looks like the range they're giving is 56 to 59 billion. The midpoint there is just about right at the average of what analysts have been looking for.
We're in this beat and raise cycle,
so
right?
57.4 billion, and maybe that is some disappointing there as well. Thank you, Allie. Appreciate it.
Of course.
Coming up, we're going to take an even closer look at Alphabet Meta earnings. Stick with us. Following the breaking results from Microsoft and Meta, both are under pressure here. Tech editor Dan Howley is in the newsroom. Dan.
Yeah, Josh, it's interesting. Microsoft beat on the top and bottom line. They also beat on cloud revenue, but we're seeing shares off roughly 2 to 3%, now about 3.5% in aftermarket. Meta, on the other hand, took a massive tax-related hit, which is why you see the steep change between EPS from last year, which was around $6, to this year, which was about a little more than $1. And so that's why you're seeing that weird discrepancy between the two is because of that charge. Now, Meta, obviously, they continue to spend on AI. The big deal here being how much they're able to bring in through the use of technology. And then we also have Microsoft, which has their Azure business. That beat on the top, on revenue. And so it seems to be a disconnect between what happened with Microsoft and seeing that decline in the share price after hours. And then with Meta, it seems to be more of a sticker shock of that EPS change from the prior year to this year with that tax-related hit that was about $15 to $16 billion.
All right, thank you, Dan. Appreciate it. Meta reporting third quarter earnings moments ago. We're bringing now Aaron Kessler, Senior Analyst of Internet at Seaport Research Partners. Aaron, great as always to see you. Let's start off with Meta here because I'm looking at the stock down about nearly 6.5% here, Aaron. What do you make of the report? What do you think explains the disappointment here, at least initially?
Yeah, it could be a combination of the tax hit, as you explained, kind of a one-time in our view, as well as I would say the expenses up a little bit, both on operating expense guidance for the remainder of the year, as well as the CapEx slightly increased as well. So that might be concerning for investors that may want to see some rationalization on the expense base. And so we'll have to look on the call for more disclosures there. But top line was strong. I would say they beat on the revenues for the quarter, ad revenues. The guidance for the quarter for Q4 also relatively strong, although largely in line with street expectations. But I would say revenue is good, maybe some noise around some of the expense issues as well as the tax hit.
They are seeing that full year CapEx, just to put a number on it, Aaron, it looks like they're calling now for between 70 to 72 billion. Is that roughly what you had penciled in?
Yeah, it wasn't far off. I believe last quarter it was 66 to 72, so a slight increase at the kind of the mid to high end of that range versus previously. I think investors want to hear on the call, though, in terms of kind of what this CapEx is going to be used for. They talked about potentially cutting some of the expenses around AI in terms of headcount. I think investors are still want to see what the ROI is on some of this CapEx spend. It's a little bit less clear for Meta versus an Amazon or a Google who's really spending that CapEx on cloud, given the strong demand those companies are seeing.
Some bulls come on, Aaron, and they said, listen, the CapEx spend makes sense to them because they say, well, we see where AI is having an impact in this name. You know, we see it in the user engagement, we see it in the ad business. Do you see that?
Definitely for the core business, we do think it makes a lot of sense continuing to spend CapEx and AI for the core business. I think our point is on the non-core business, the super intelligence investments, less clear how they're going to monetize that at this point. It's obviously a multi-year plan as they talked about, but I think investors want to see a little bit more concrete data, concrete thoughts on exactly how they're going to monetize some of these non-core areas.
So that having been said, Aaron, about listen, we got tax issues, expenses, CapEx. Having said that, you remain bullish on their name. You tell clients this one's a buy. What are the catalysts ahead that you see here?
Yeah, no, still expect continued strong revenue growth. Obviously, another quarter of 20% plus ad growth we saw in Q3. Q4 guide implies another 20% growth. We think it can grow mid-teens top line growth for advertising in 2026. And we think valuation is still undemanding. It does get a little bit more expensive if you look at it on a free cash flow basis, given that CapEx spend. So I think that's maybe where investors have a little bit of hesitancy. But on our GAAP earnings basis, we think we had them doing around $30 of GAAP earnings in 2026. So fairly reasonable valuation given their growth rates.
And so I guess you if you're bullish on the name, then Aaron, you agree with Zuck and you think, hey, listen, there's a huge opportunity here. We've got to invest to capture it, to capture that AI demand.
Yeah, definitely. I think it's the right move for now. At the same time, if they're not seeing a good ROI, or I think they need to have that option to pull back a little bit. And I don't think investors would be displeased if they decide not to spend another 30, 40 billion next year incrementally on CapEx. So that's the question. I think investors just want a little bit more color. Are they getting a good ROI in that CapEx spend?
They are integrating that AI as well into the hardware, Aaron. So, you know, it's the glasses, right? Are you as enthusiastic about the hardware?
I would say I do like the glasses, the sunglasses initiatives with the kind of the Ray-Bans partnerships. I think less clear on the VR side. We don't think that's seen mass market adoption, and still less clear really if that will get mass market adoption long term. So do like the glasses investments, but less positive on the VR side.
So you're bullish, and you make the case, Aaron. When clients ask you, okay, with the stock down here about 6%, what are the risks I need to think about? What do you tell them?
Yeah, no, we still are bullish. We still, at the end of the day, as long as advertising growth is still growing kind of 15% plus range as we go into 2026, which we think it will be able to grow mid-teens plus. They still have a lot of option value in terms of these investments they're making. But if you look at the earnings power, especially if they pulled back on these investments, pretty significant earnings power that would drop down to free cash flow as well as GAAP earnings. Let's
shift gears here because I want your take on Alphabet as well. Now that's a different story. Alphabet well in the green here. We are up 6% in the after hours. Impressive, Aaron, because this stock had already soared. It was up about 40% year to date heading into this print. Now you're tacking on another 6%. Give me your thoughts on this report.
Yeah, so it's really a combination of good advertising growth. as well as good growth for their cloud business. So I think Google for a while was perceived as a cloud loser or AI loser, and now they're being seen as a kind of a clear AI winner, both on their advertising business as well as for GCP. And I think GCP has been doing a nice job. Looks like they grew kind of mid 30% range for GCP, another very strong quarter there. And so that's starting to get a pretty healthy multiple as well. We think you can give Google Cloud Platform kind of high single-digit revenue multiple on the business. And we were at a $310 price target for Google, but continuing to see good ad growth. We're not too worried about competition on the ad side at this point, continue to monitor that. But a combination of good ad growth plus good GCP growth, investors are willing to pay a higher multiple for Google today versus a few months ago. Plus the regulatory side looks to be off the table for the most part.
A big question around search, Aaron, right? Looking ahead, how much of a risk does OpenAI pose long-term, in your opinion, to that core search business?
Yeah, it is a risk. I mean, clearly close to 1 billion people are using kind of OpenAI or ChatGPT on a monthly basis. It's for a lot of younger users, they're using it pretty frequently. At the same time, Google has said over the last couple of quarters, users continue to use Google AI or Google and AI overviews, a driver of increased search activity as well. So at this point, we think ChatGPT has been more used for informational search versus commercial searches. If you think about commercial searches, whether it's e-commerce, travel searches, we think those are still largely being done at Google. I got to imagine ChatGPT, Perplexity, others have ambitions to get more aggressive on that side longer term. So something definitely to watch for. But at this point, we don't think Google's been losing share, or at least continue to grow search at a pretty healthy rate.
And I know you're a bull on the name, so even though it's enjoyed this strong run, Aaron, you must believe valuation is still attractive on this one?
Yeah, no, so we had a 310 price target coming into it. It was trading around a mid-20s GAAP earnings multiple. Still think they can grow GAAP earnings kind of at a mid-teens growth rate, so kind of a 1.5 or so peg, which we think is pretty reasonable given their top line and bottom line growth here. And so, yeah, we think as you go out to 2027, a pretty reasonable multiple there as well.
Last question, Aaron. So you got Meta. You got Google. What is your hot take broadly on the digital ad market? How healthy, how strong does it look? And do you expect it to look? And are there read-throughs here, Aaron, to what we could hear from Amazon and its ad business?
Yeah, no, I think for the large platforms, Google, Meta, we think Amazon as a large platform will continue to see pretty good momentum. We've seen some of the smaller players on the advertising side not do as well, as they may be losing share. We do expect Reddit to have strong results tomorrow as well, and also Amazon on the advertising side. So do expect a good quarter for the larger platforms and advertising continuing to gain market share.
Aaron, always great to see and to have you on the show. Thank you.
Great. Thanks, Josh.
Time now for what to watch Thursday, October 30th. We're going to start off on the earnings front. No slowdown this season. Two more Magnificent Seven names reporting on Thursday with Apple and Amazon. Apple's going to be reporting fourth quarter earnings. That's after the markets close. iPhone sales are in focus for Apple's report, with China showing signs of strong sales but weaker numbers in the U.S. Investors will also be looking at guidance. Analysts are anticipating Apple to face higher costs because of tariffs, about $1.3 billion this quarter and up to $2 billion next quarter. We'll be getting some Fed commentary on Thursday from Fed Vice Chair for Supervision, Michelle Bowman. This is coming after the Fed cut interest rates at October's FOMC meeting on Wednesday. Fed Chair Jerome Powell saying in his post-decision press conference that there are strongly differing views about how to proceed and that another cut in December is far from a foregone conclusion. And moving over to housing, weekly interest rates from Freddie Mac coming out on Thursday. The current rate on the 30-year fixed is 6.19%. Mortgage rates have dropped for 3 consecutive weeks leading up to Thursday's release. We've got more earnings coverage, including Starbucks and Chipotle after the break. Keep it right here.